Planning for retirement involves building a corpus during your working years to secure your future. A well-structured retirement corpus serves as a financial safety net covering essentials, medical expenses, and lifestyle goals. The key lies in managing this wealth effectively. Here arises a question: where to invest money after retirement for monthly income while ensuring it lasts your lifetime? In this video, let's explore strategies to make your retirement savings work effectively for you. Welcome to holisticinvestment.in. In India, most retirees gravitate towards conservative investment strategies that prioritize steady income and low risk. But what are the best options to safeguard your savings while ensuring regular returns? Let's take a closer look at some popular choices tailored for financial security in your golden years. First, Senior Citizen Savings Scheme, a government-backed scheme with a 5-year lock-in extendable by 3 years. A Senior Citizen Savings Scheme currently offers 8.2% per annum. It provides quarterly interest payouts, making it a reliable option for regular income. While the principal is secure, the interest income is taxable. Next, Fixed Deposits. Bank and post office fixed deposits are safe investments offering predictable returns. Current interest rate range from 6% to 7% per annum, with special schemes for senior citizens offering up to 7.5%. Retirees often ladder FDs to ensure liquidity and mitigate reinvestment risk. Corporate deposits often provide higher interest rates than bank fixed deposits, making them attractive to some investors. However, retirees should approach these investments cautiously due to several risks. Retirees generally have lower risk tolerance, and preservation of capital often takes precedence over higher returns. Next, rental income. Retirees owning real estate may earn regular income through rent. This option provides steady cash flow but comes with challenges like tenant management, property upkeep, and occasional vacancies. Next, Post Office Monthly Income Scheme. Designed for regular monthly payouts, POMIS is a 5-year investment scheme offering 7.6% per annum. While safe and reliable, the maximum investment is capped at 9 lakh for single account and 15 lakh for joint accounts. Next, RBI Floating Rate Savings Bond. These bonds offer biannual interest payouts linked to the prevailing National Savings Certificate (NSC) rate with a current rate of 8.05% per annum. The floating rate ensures returns are adjusted to market conditions, providing protection against inflation. However, the 7-year lock-in period restricts liquidity, making them suitable only for those who don't anticipate immediate cash needs. Next, Pradhan Mantri Vaya Vandana Yojana (PMVVY). Available for investment up to 31st March 2023. Exclusively for senior citizens, PMVVY offers assured returns of 7.4% per annum for a 10-year tenure. It provides guaranteed income but lacks flexibility once the funds are locked in. Next, annuity plans. Insurance companies offer these plans for a steady income over a lifetime or fixed period. Annuity amount depends on the chosen options like immediate or deferred annuity, with or without return of purchase price, single or joint life. Income is taxable and returns are generally lower compared to other options, but they ensure lifelong payouts. Next, let's explore how a combination of these investment options can work in a practical retirement scenario. But before diving into calculations, it is essential to recognize some options that may not be suitable for retirees. Take annuity plans for example. While they offer a guaranteed income, they come with notable drawbacks. Their lack of flexibility. Once your corpus is locked into an annuity, it is tied up with no access to funds for emergencies or other personal needs. The payout structure is also fixed, and the remaining corpus is only available to your nominee after your passing, rather than being accessible to you during your lifetime. Now, for these reasons, we generally advise against pre-packaged pension or annuity plans for retirement. Additionally, it is worth noting that Pradhan Mantri Vaya Vandana Yojana scheme is currently unavailable for investment. And next, when planning for retirement, retirees should prioritize options that offer safety and reliable income. While corporate deposits might seem appealing due to their slightly higher returns, they carry risk that often outweigh the potential benefits. In comparison, government-backed schemes or insured bank deposits provide a more secure foundation for a comfortable retirement. To illustrate the potential outcome of a conservative investment strategy, consider a 1 crore retirement corpus allocated among the following instruments. Senior Citizen Savings Scheme 30 lakhs, Post Office Monthly Income Scheme 15 lakhs, RBI Floating Rate Bond 15 lakhs, Bank Fixed Deposit 40 lakhs. This allocation provides a weighted average return of 8% per annum with an annual withdrawal of Rs 5 lakh increasing by 6% annually to account for inflation. The corpus appears sustainable initially. However, as withdrawals increases over time, the corpus starts to deplete. The retirement corpus turns negative, leaving a shortfall of 5.43 lakh by the age of 85. While this approach provides a predictable income and preserves capital in the early years, it faces significant challenges. First, erosion due to inflation. Despite steady return, rising withdrawal outpaced the portfolio's growth, depleting the corpus. Next, no long-term sustainability. This strategy fails to last throughout retirement, leaving retirees vulnerable in their last years. Although these conservative options may seem comfortable initially, they may not provide a sustainable solution in the long run. In the next section, we will explore strategies to overcome these shortcomings and ensure the corpus lasts a lifetime. Here is a detailed split of 1 crore investment for retirement corpus, ensuring both regular income and capital appreciation. Split of 1 crore investment. First, Senior Citizen Savings Scheme Rs 30 lakhs. This provides stable and predictable interest income. Current interest rate is 8.2%. Next, Liquid Fund Rs 3 lakhs. This acts as a buffer for the first year's expenses, ensuring immediate liquidity. Can be used entirely in the first year for living expenses, minimizing early withdrawals from other investments. Next, debt funds Rs 34 lakhs. This provides stability and ensures periodic income via systematic withdrawal plan. SWP allow periodic withdrawals from investment. This supplements Senior Citizen Savings Scheme interest. Debt funds has a moderate growth potential with lower risk compared to equity funds. Next, equity fund Rs 33 lakhs. This portion is allocated for long-term capital appreciation. It remains untouched for the initial years to allow compounding. In the first year of retirement, the living expenses amount to Rs 3 lakhs which are fully funded from the liquid fund. During this period, no withdrawals are made from either debt or equity funds. To supplement income, the interest income earned from the Senior Citizen Savings Scheme 2,46,000 provides additional financial support. From the second year onward, the strategy shifts to creating a sustainable income stream that adjusts for inflation while balancing growth with stability. The steady interest income of 2,46,000 from Senior Citizen Savings Scheme continues to play a central role in this plan. Any gap in expense is covered by systematic withdrawal plan (SWP) from the debt fund. To keep the retirement corpus growing and manage risk effectively, a portion of equity funds gain is transferred into debt funds, ensuring the debt pool remains adequate to support withdrawals while also reducing portfolio volatility. This disciplined approach helps to maintain an inflation-adjusted income throughout retirement. For example, in the second year, that is at the age of 62, total withdrawals amounts to Rs 5,30,000. By the 20th year, that is at the age of 80, the withdrawal increases to Rs 15 lakhs adjusted for inflation. Despite these withdrawals, the corpus continues to grow steadily and remains well balanced thanks to the regular equity to debt rebalancing and strategic financial management. As retirement progresses, particularly by the age of 75, the remaining equity portfolio is fully transitioned into debt funds, ensuring stability in the later years. This shift reduces risk while continuing to support regular withdrawals and meet ongoing financial needs. By age 85, the corpus remains strong, consisting of Rs 61 lakhs in debt funds and Rs 30 lakhs in Senior Citizen Savings Scheme principal, which continues to generate consistent interest income. This results in a total corpus of 91 lakhs, providing financial security throughout retirement and even leaving behind a legacy for the future. While equity investments are volatile by nature, the allocation to equities and timing of the transitioning funds to debt can be adjusted based on the investor's risk tolerance. The strategy outlined here demonstrates a thoughtful approach to securing a stable and sustainable income stream during retirement. Here is the advantages of a diversified investment portfolio. First, regular income. Senior Citizen Savings Scheme and systematic withdrawal plan meet yearly living expenses. Next, capital appreciation. Equity growth adds to the corpus for the future stability. Next, stability in the later years. A full shift to debt ensures minimal risk after age 75. Here is our conclusion. The ideal strategy for investing retirement corpus. An effective retirement investment strategy strikes a balance between stability, growth, and income. By diversifying investment across equity, debt, and secure investments like senior citizen savings scheme and RBI bonds, retirees can enjoy regular income, protect against inflation, and achieve capital growth. Periodic rebalancing between equity and debt further helps in managing risk while ensuring the longevity of the corpus. This well-planned approach not only sustains financial security throughout retirement but also guarantees peace of mind. After all, isn't it the ultimate goal of retirement to enjoy your later years with confidence and financial independence? A detailed blog post on this topic is available on our website and the link is given in the description. Hope you like this video. If you have any questions related to this or any other investment option or related to your financial goal, don't hesitate to book a free appointment with our financial planners. The link to the free booking is given in the description box below. Also, will you be interested to attend any insightful investment webinar? Then feel free to register for the upcoming enlightening investment webinar. It is completely free. The registration link for the upcoming webinar is also given in the description box. If you like this video, please give us thumbs up. Also, share it with your social circle. If you haven't subscribed our YouTube channel so far, please subscribe now.